Hey guys, Ben Nash from Pivot Wealth here, and today I'm pumped to be here. This is our very first client-only monthly investment update. So, would love to get your thoughts. Is it helpful? Do you hate it? Please, no comments about my beard. The barbershops are all closed. So, I just wanted to though put this together because we've been getting a bit of feedback from clients saying that they'd be keen to get our take on, I suppose, where markets are at, share market. In different investment markets, Australia and around the world, property market. So I'm keen to just share some of our insights, some of the things that we're seeing in markets, and then I'm going to share a couple of tips and hacks, mainly driven from experience from some of the people we've been working with over the last little bit. So look, where we stand, July 2021, we in the middle of this bloody COVID lockdown. It's causing a bit of havoc. Our mate, the Delta variant, is really not doing anyone any favors, causing a lot of disruption in Australia. Sydney's been in lockdown. Fortunate to have this going for like a month and a half. Really showing very few signs of slowing up at this point. That is flowing on to the economy. We're seeing a lot in New South Wales in particular. I think the last insight that I saw was that something like $15 billion and counting that they think in terms of the uptick in the downturns rather in economic activity as a result of this lockdown. One positive that's come, well, if you can take the silver lining, is that the government seem again prepared to step in and support businesses and individuals to minimize somewhat the impacts of COVID. We're seeing a fair bit of stimulus for businesses, in particular those that have been really heavily impacted from the lockdown, and we're seeing a much more targeted approach this time to how the government's tackling it. It seems that they've learnt their lesson from JobKeeper, that there are a lot of quite profitable companies that got significant cash from the COVID stimulus. So now they've changed how they're doing it, how they're assessing things, which means that you really need to be it will significantly negatively affected in order to qualify. But that is coming through. What that is really about, though, is making sure it's not going to do any short-term positive economic impact. It's rather just allowing businesses to come out of this downturn and sort of keep their jobs, spring people into what is the next stage of this, the recovery from COVID. So, look, my view is there's one area in particular that is impacted as a result of this, which is the property market, and I think that this downturn is probably going to be a bit of a drag on prices, although off the back of what we've seen over the last sort of 6 months and the last quarter in particular, there has been some pretty staggering growth. For anyone that's in the property market or has been, that you're no doubt seeing that. So I was looking at an article the other day that showed that I think Seaforth was the highest increased suburb in the New South Wales area at like 40% in the last 12 months, which is pretty insane given that the median house price there is like $3 million or something. This is fueled in a big part by the massive the ultra low interest rates and relaxation to the borrowing standards, which is allowing more people to borrow. There's been a bunch of suburbs. I've got a list here, Dover Heights, Saratoga Bronte, Belmore, Evoca, Bilgola. The Northern Beaches have been a big favorite here, as well as places like Pitt Town, Maroubra, Wentworth Falls is another one, and these places, they're for people getting a bit of a sea change or getting a bit more space. Potentially they have been undervalued relative to the rest of the market for the last little bit, but we're seeing some massive growth there. And interestingly, in contrast, that there are a bunch of suburbs where the weakest growth has been. Barton Ridge is the worst at negative 6.4%. Leppington, Ashfield, interestingly, Mount Colah, Marsfield, Mount Druitt, Stanmore, Cabramatta. So a bit of a mix in there, but a lot of them are being further out suburbs where there is much more supply. And I think the stats show that they're pretty consistent with our philosophy around property, which is really that places where we've got strong expected population growth but very limited supply are the ones that are going to go up in value. And I think my personal view is that there's still a lot of opportunity in markets at the moment. I should disclaim all this by saying, please seek out personalized advice before jumping in. But my view is that there's still a lot of opportunity there with the interest rates where they are. And even though there has been some good price growth in a lot of suburbs, that we're still seeing, we're going to have strong population growth moving forward. We do still have limited supply. You look at areas like those northern beaches. I was reading an article a little while back that was saying around the new development applications in terms of the density of housing, and it was all about the beaches that basically all very, very low numbers of new dwellings approved in those areas. So to me, it's no surprise that these are the ones that have got the most growth, because you're getting an influx of population with limited supply. So people that are coming into the market are having to pay more. So I think that with the interest rates, and the interest rates are an interesting one, that the more people buy property at this level, that it's the more and more difficult it becomes for the RBA and the economists to justify increases in rates and stuff, because they know that it's just going to cripple a whole bunch of people. So, I don't know what sort of strategy that is, that if all Aussies rush out and borrow as much as they can, that the RBA is going to be a bit over a barrel. But if it's important, obviously, to be smart with how you buy property. But if you are, then my view is that there's still a lot of good long-term opportunities there. And I've seen a few success stories for clients in the recent past on that front as well. For anyone that's looking at property, make sure that you've got that good defensive strategy in place. But I think, there's... I think don't be scared. It's like we were seeing a lot of people in the last COVID slight dip in markets that they wanted to get in, and everyone's waiting for this never-ending crash that just doesn't seem to be coming. Look, it's there might be still a decline, but it's given the fundamentals are there in the Australian property market that my view is that there will still be prices supported into the foreseeable future, at least. In terms of the share market, in the last month, we've seen the Australian share market has sort of been broadly tracking sideways, but ended up at 1.6% up for the month. Is sort of similar in America. The S&P 500, so the 500 largest companies in America, are up 1.7%. NASDAQ a little bit lower, up 1.04% rather. That was off the back of a pretty phenomenal quarter before that, where the tech stocks are rallying very, very hard. They massively up over the last little bit, with the whole world moving into their COVID bunkers. Globally, though, slightly different story that are around the world. The FTSE, or the FTSE 100 index, which is the 100 largest companies in across the world, was down 1%. That's driven in a big part by the continuing just economic sort of sideways movement in Europe, and a few economies really struggling over there. But again, that they've recovered really strongly over the last 12 months for those markets too. The crypto index, so there's a S&P cryptocurrency index, which tracks the biggest cryptocurrency coins and digital assets around the world. That's up 60% in the last month, and more investors, we're certainly seeing more and more activity from investors around crypto, and including that as part of their portfolios, off the back of a widespread adoption from some of the bigger market players and financial institutions around cryptocurrency in particular. I'm pretty bullish on crypto in the next little bit, and that was not the case on this up until the recent past, but it just seems more and more undeniable. Clearly very volatile though, so again, you need to be very careful including it in your portfolio, but I feel like it's increasingly has a role to play for smart investors, and that's definitely one we're going to be keeping a really close eye on moving forward. We're working towards trying to find some solutions there that make it easy for people to invest. In fact, ASIC, who are the Australian Securities and Investment Commission, they're the regulator that oversee financial markets. They've just released consultation for a discussion paper around getting a cryptocurrency ETF into the Australian market. Interestingly, in Canada, they approved this, and I think within a matter of 3 months or something, there was billions of dollars invested into their crypto ETF portfolios. So watch this space on that front. Good to see that technology development making it, and financial product innovation as well, I suppose, making it easier for investors to get into the market. In terms of some of the broader, like what's actually going on in the economies, both in Australia and the rest of the world, we've seen in the last quarter, 1.8% has been the GDP growth, which is actually pretty good on a quarterly basis. Compared to normally we pre-COVID would sort of run at about 3% over a year. So 1.8%, pretty strong over a quarter. The previous quarter was 3.2%. So the growth has slowed down, and no doubt in this quarter, we're going to see probably a bit more of a decline off the back of the continuing COVID lockdowns. Unemployment rate, though, has gone down 5.1% from 5.5% in the previous quarter, which is good to see. More people in jobs. I read a stat the other day that said that we've actually got the lowest jobless rate in the last like 50 years or something like that. So more people in jobs. Hopefully that translates to stronger wage growth, and that drives a lot of share market activity, property market activity, and growth for investors as well. So for people, it's more, I suppose, encouragement around markets and the short to medium term outlook for markets as well. Inflation rate 1.1% over the quarter, which is good to see some inflation. It's not in America. They've got quite a bit of inflation with people coming out the back of COVID now, but in Australia, that seems like a reasonable level, which is good. It means that they're not going to put too much pressure on the RBA to reduce interest rates for homeowners and borrowers, which is important given the current borrowing and debt levels, until we get a bit more of that wage inflation that I was talking about to reduce that burden on people as well. Our interest rates are still ultra low at 0.1%. Unfortunately, that's not what you get from your friendly local banker down the road, but it's as low as they're going to get, you would think. And consumer confidence, we're seeing a bit of an increase, although on the flip side, a decrease in business confidence. So again, keeping an eye on things, I suppose it probably makes sense given the dynamics of what's going on in the economies at the moment. Looking at the US data, though, slightly different story. We've seen in the US, their GDP growth rate is 6.5%, which is pretty massive, 12.2% for the year. Now, not unexpected given the severity of the COVID contraction over there. So they're bouncing out pretty strongly off the back of that. That's good. But tied in with that is the inflation rate is creeping up there, 5.4%, which is going to be a bit concerning for the Federal Reserve. When the inflation creeps up, the governments want to curtail that. The mechanism that they typically use to do that is increasing interest rates. But because the economy is in a bit of a precarious position, the central banks are generally going to be reluctant to increase those interest rates, because it's going to have a negative effect on the growth of the economy, which they want to stimulate that growth as well. So interesting, a bit of mixed messages there. So it's a bit of a watch this space in terms of how they're going to play it moving forward. But on one side, it's positive because the more people spend, the more economic activity that fuels. So wait and see on that front. The unemployment rate, though, is actually increasing. It's upticked from 5.8% to 5.9% over in the US, which is slightly up. I'm not sure if that's partly off the back of the wind down in their stimulus over there, but potentially could be. It's pretty in the margins though, but probably not the best news for them. But on the positive side, it could have the impact on that inflation rate that I was just talking about. In terms, I got to share story of the month. We track this on a weekly basis and keep an eye on the big market movers. And one of the ones that has been really interesting for me is ARB Corp. They're listed on the ASX with the ticker ARB. They distribute and sell motor vehicle accessories and specialize in four-wheel drive cars. You wouldn't have thought that a manufacturing company like that would be performing so well, but clearly the COVID has got people thinking about their four-wheel driving. They're up like 130% in the last 12 months, and their revenue, the share price, I mean, is up 130%. Revenue growth is up over 33%. So clearly a lot of people getting out there full driving. And look, with the lockdowns continuing, I'm not sure if that's considered exercise with the steering wheel, etc., but potentially, depending on how you look at it. So I think that and the fact that no one can go overseas for the next bit puts them in pretty good stead moving forward. Look, I've got a money tip or hack here, and I just wanted to actually, instead of talking about a specific client story, talk about, in the last little bit, I have been doing a series on responsible investing on the How to Be Successful with Money podcast. I've been interviewing a bunch of people that have either investment fund managers or economists, and people that get involved, and a couple of other financial advisors actually, that get involved in socially responsible investing. And it sort of opened my eyes to the development that's happened in this space in the last little bit. And so over the next little bit, we have it squarely on our radar to build out some more socially responsible portfolios for our clients. There is a bit of a transparency issue, which seems weird to say in the ethical investing space, because you'd expect the ethical companies to be, transparent and ethical. But there are a few companies that just don't report on their stats. Now, they say that it's a logistics issue, but that just doesn't really sit right with me, given that one of our core values is that painful transparency. So we are keeping a really close eye on the players there. We've actually talking to a couple of product providers about creating some solutions that are going to be able to deliver on some quality, socially responsible impact type investing mandates. I'm really excited to see that coming together. I've sort of learned a lot from going through that process. And one of the big takeaways for me was around how companies, how the cost of capital will impact the growth of companies moving forward, and essentially transition the economies from less sustainable companies to more sustainable companies. I was talking to a really senior economist that has been in the space for about 20 odd years, and was talking about the fact that when people invest into companies and either buy shares, or when the companies issue more shares, or even when they borrow from the banks, or raise money through like corporate bonds and that sort of stuff, that the people that invest with them, and in particular the institutions that invest with them, they're looking really at the long-term prospects of these businesses. And I hadn't really thought about it with this lens before, although there's probably a strong argument that I should have. But they were talking about the fact that if you think about, say, a mining company, for example, like a coal mining company, and coal mining is one of the first things, coal mining and fossil fuels is one of the first things on the radar for a lot of people that are looking to invest in a socially responsible way, that if we fast forward 50 years, if no one wants to invest in these companies, their share price will be depressed. They got limited capital for their expansion and growth, and then it's going to be more difficult for them to borrow money from the banks or from like bond issuances and stuff. And that's going to naturally have an impact of slowing down their growth. And on the flip side, when you've got these more sustainable, renewable companies that are either having a positive impact on the planet or no negative impact on the planet, what that means is that it's easier for them to get investors to borrow money, to issue bonds and that sort of stuff, which fuels further growth and means that the companies that are less sustainable, they end up getting left behind. And we see that the more sustainable or socially responsible companies can move ahead. And I think that you'll naturally see that transition as that space progresses. So yeah, it was an interesting realization to me that I hadn't quite thought about in that way, but I think it's something that is an opportunity moving forward to get a little bit ahead of the curve, although clearly there's a lot of support behind sustainable investments, but to get a little bit ahead of the curve to future-proof your portfolio. So more on this coming in the not too distant future. Client problem or client mistake of the month. This is something we saw with a recent client that caused a lot of headaches, and I thought a lesson that some of you guys might be able to learn from. The client came to us and they had purchased actually 3 properties in areas outside of metropolitan areas, sort of regional type properties. And they'd done this off the back of, they'd done a bunch of research and they'd spoken to a few people, and they they figured that property investment was a good move, which, we think property investment is a good move, but they bought, in order to do that in a way that they thought they wanted another income stream. So they bought these properties that they felt were going to deliver them more income. Now that all seems to make a lot of sense, but when it came down to it, or when we started looking at the numbers, it became clear that they bought properties in areas that had significantly lower growth prospects than their counterpart, than the alternative investments in the more metropolitan type areas, mainly as a function of significant ability for supply, i.e. regional areas where there's a lot of land and a lot of subdivisions and stuff that are happening, and also limited demand in that these places a lot of regional areas have they have decent population growth, but they don't have as much population growth as we do in the metro type areas. So this person had, they bought these 3 properties. They were all like the $300,000 to $400,000 mark. Not bad looking properties, but when we did the numbers, they actually started kicking a ton of goals in their work. They had to work for a tech company, had a bunch of RSUs and stuff. And as a result of that, they ended up with more money available than they anticipated. And they wanted to then buy another property, and after hearing our philosophies, they wanted to buy something that was a bit more metro with more growth prospects going forward. And then they also wanted to buy their own home and shell out like a pretty penny for that property as well, but to do it in a way without a lot of debt. Now, the other part was that when we unpacked the intention around purchasing the properties in the first place, this client had bought these properties because they heard all these things about passive income or investment income, and they thought that was what they wanted. But it became clear that they didn't actually need another income because they had a strong income from their employment and they weren't intending to wind back from the workforce anytime soon. What they thought was that they just wanted to have they thought they wanted passive income, but what they really wanted was just to have a good investment. And when it comes to property, a big part of the appeal of property, well, there are 2. One is the borrowing power, that you use a small amount of money to have this big asset working for you. The second is that you buy a property for $1 million today, and in the future it's worth $2 million or more, because you get that compounding impact over time. Now, if you're trading off a modest amount of income, which is then taxable when you're on the top marginal tax rate, the income benefit to you of the properties is somewhat limited or certainly reduced. But what you really want is that growth, which you can sell off in the future to create more capital, which you can then invest into other areas to create the investment income at the time that you want it. But unfortunately, this client hadn't come to that realization when they purchased these properties. And so they had properties with less growth prospects, with income that they didn't really need. And because they had all this borrowing for the different properties, it was impacting their ability to be able to do the other property strategy that they want. Now, we're in the process of untangling some of that, and we're making a few trade-offs that are going to ultimately lead to a better outcome, as in potentially offloading 1 or 2 of those properties to facilitate further borrowing capacity. And look, the person's in a strong position, but the reality is that if they if they were clear on all of those issues before formulating their property strategy, they would have chosen a much different approach. And the unfortunate thing with property is that it's expensive to buy and sell, it's time consuming, and then you have this psychology stuff that sits around it, meaning that you get sort of tied up on the property, and you're reluctant to do things. It can mean, thankfully, this client was really onto it and prepared to recognize that there was a bigger opportunity at play and pursue that. But a lot of people don't quite come to that realization, and as a consequence, they end up missing out on the ability to get the growth and the financial results that they want. So I just thought it was an interesting situation that came up that, well, I have seen before. So I wanted to share it in the hope that you, or when next time you're talking to your mates at the virtual barbecue, which we have to do these days, is that you give them that word of warning to really be considered with your property strategy before you jump in, so that you can avoid those headaches and costs and ultimately work towards the results that you want. A little bit of an update on the Pivot side, the things that we're working on. We've actually just done a big overhaul of all of our ongoing services. More on this will be communicated soon as part of the ongoing work that we do, the ongoing client meetings and stuff. But we're really excited that we've restructured things based on a ton of feedback that we've got from a number of our clients. And really excited for moving forward from here. The other big news, and this is coming down the line, that we're actually in the process of getting our own Australian Financial Services License, or AFSL. We've been co-oping a license for the last 5 years or so, and sharing the license across 5 different businesses and sort of pooling resources. But as Pivot's grown and as the licensing stuff has evolved, we have made the call that that's not the right path moving forward. So ultimately, having our own license will give us total control with the support of a really fantastic compliance team that we've got in place now. But meaning that we're sort of master of our own destiny when it comes to the strategies and products and solutions that will best suit our clients. So some more communications will come on that in the not too distant future, but really, really exciting times. And in other news, something that I'm quite excited about is that it's Pivot's 6th birthday, 3rd of August. So celebrations this month. Really, really pumped to sort of look back, and it's amazing to see the stuff that's happened in the last 6 years. Pivot's grown into a thing from me just sort of punching away with a bunch of clients to this a business that's able to have a much bigger impact and working with literally hundreds of people on helping them up their money game. So really excited. Stay tuned. We'll be communicating a bit more on that now, but over this month. But really excited, guys. Hope you found that helpful. Would love it. How did you find this? Any feedback, things to include? Would love to hear your thoughts. Cheers, team. Bye for now.